Hi folks, today we're diving into a topic that's crucial for investors looking to scale up without using all their own cash, creative financing options. I know cash is king sounds great, but sometimes cash isn't enough. So let's explore how creative financing can unlock doors that traditional loans just can't. First up, seller financing. Let's say you find a property, but the bank says no to a loan, or the seller's willing to get creative. In seller financing, the seller acts like the bank, and you pay them directly, often at an interest rate that benefits both sides. Why is this great? Less upfront cash for you and faster closing time, but be cautious. You'll need to negotiate the terms carefully, things like down payment, interest rate, and what happens if you default. Always consult a real estate attorney or professional. Next, we have the lease option or rent to own. This is where you lease a property with the option to buy it at the end of the lease term. It's a great option if you're still building credit or need time to arrange financing. Plus, it allows you to test drive the property. Just remember, you'll likely pay an option fee upfront and a slightly higher rent that goes toward your future down payment. Make sure you're serious about buying before going this route. Hard money loans? Now we're getting into more aggressive territory. These are short-term loans secured by the property itself, typically from private lenders, not banks. They're ideal for flippers, or if you're buying distressed properties. The big pro here, you can get funds fast, sometimes in days. The con, higher interest rates and shorter repayment periods. But if you're in the flipping game or looking to buy cheap and rehab, hard money can make it happen. Now let's talk subject to financing. This is when you buy a property subject to the existing mortgage. The seller transfers the deed to you, but the mortgage stays in their name. Sounds risky? It can be, but it also allows you to acquire property without a down payment or loan of your own. Be careful with this one. If you default, it affects the seller's credit, and the lender could call the loan due. It's creative, but carries its own risks. Lastly, we've got wraparound mortgages. You're essentially taking over an existing loan and wrapping a new mortgage around it, paying a higher interest rate to the seller than what they owe. This can help you get into a deal where traditional lenders won't go. This is similar to subject to, but with different legal and financial structures. So again, get legal advice before diving in. There you have it. Creative financing is a powerful tool to grow your real estate portfolio when traditional financing doesn't cut it. Whether it's seller financing, lease options, or hard money loans, each method has its advantages and risks. The key is to understand what you're getting into. So, what do you think? Have you used any of these strategies before? Share your experiences in the comments below. Soon I'll have more real estate advice for you.